to the dissolution of your firm, and this is question 11. A, B, and C are equal partners whose balance sheet on December 31st, 2014 is as follows. So you have the balance sheet there, liabilities and assets. On the liabilities side, we're having sundry creditors 5,000, A's loan rupees 1,000, capital account A and C 800 and 500 respectively. And on the assets account, we are having cash in hand rupees 50, stock rupees 800, debtors rupees 1000, plant and machinery rupees 2000, furniture and fittings rupees 800, land and buildings rupees 2000, and capital of B, which was overdrawn, rupees 650. Additional information. Due to lack of liquidity and weak financial position of the partners, the firm is dissolved. A and C are not able to contribute anything, and a sum of rupees 200 is received from B. Now all of them are declared to be insolvent. And the assets realized: stock rupees 500, plant and machinery rupees 1000, furniture and fittings rupees 200, land and buildings rupees 800, and debtors rupees 550. Realization expenses amounted to rupees 50, and they've asked us to close the books of the firm. Okay, so in this particular question, you will notice that they've given specifically that all of the partners are declared insolvent. There is no partner who is capable of bringing in money in order to pay off anything extra. Okay, so generally when we prepare, we have your realization account, right? When we close the books, we have realization account, partners capital account, and we also have cash account. But under this situation, we also have to prepare an additional account, which is our deficiency account. Okay, so we have to prepare a deficiency account because it's been given here A and C are not able to contribute anything, and all of them are also declared insolvent. As a result of that, you have your sundry creditors who will not be paid off. At the same time, you'll be having a deficiency account. So we'll be having 5 accounts in total. The 3 accounts that we normally prepare: realization, partners, and then cash account. And because they are all insolvent and they can't pay anything, your sundry creditors will not be paid off, and you'll also have a deficiency account. Okay, so 5 accounts in total. So let us start first with the first account, which is realization account. So as usual, we're starting first with the realization account. So in the realization account, remember, we record all of the assets and liabilities at their book values, and then we sell off the assets and we make good the any liabilities in case we have money. So firstly, let us record the assets at their book values. Now in this question, you've also been given the date 31st of December 2014. So please make sure you also have a date column, and under the date column, you're writing 2014 31st of December. Okay, so under the debit side, to stock account, all of the assets that you're having, right? So to stock account, stock is rupees 800. Again, remember, we don't record cash in your realization account. It goes directly to the cash book or cash account. And then you also have debtors account. Debtors are rupees 1000. And we have plant and machinery account. So plant and machinery, plant and machinery is rupees 2000. And then we have furniture and fittings. Furniture and fittings account amounting to rupees 800. And we have also land and buildings account. So land and buildings account rupees 2000. And then after that, you have B's capital overdrawn, which goes, of course, to your B's capital account. Okay, so stock 800, debtors 1000, plant and machinery 2000, furniture and fittings 800, and land and building account rupees 2000. So now let us sell these off and realize a certain value on them. Okay, let's sell these off and realize the amount. So when we are realizing the money, again, 31st of December 2014, by cash account. So by cash account, they've given us in the additional information the values of your assets that you are realizing. So you have stock, and then we have also plant and machinery, and we have furniture and Lannan Buildings, and finally we also have debtors. Okay, so under stock, value of stock we are realizing is rupees 500, and then value of plant and machinery is rupees 1000, and then for furniture and fittings it is rupees 200, and then in case of land and buildings rupees 800, and on debtors rupees 550. Now you may also opt to write these values in the inner column like so, and if you write it in the inner column, in fact it's a lot more efficient because you're able to calculate the total and see how much you are earning on the realization of your assets. Okay, so you can write it either in the inner column or straight away to the outer column. So we have written them in the inner column, and total we are getting on realization amount is rupees 3050. So on the sale of our assets we are realizing an amount worth rupees 3050. And then in the question they've given us realization of expenses amounted to rupees 50. So let us record that. It will be to cash account. We're paying realization expenses. So realization expenses amounting to rupees 50. Okay, now we also have another liability, right, in the question. We have another liability in the question, which is sundry creditors. Now you'll notice that I did not record the sundry creditors in the realization account. The reason being, not all of the partners are declared insolvent. So even if I do record it here, it'll be almost as if there is no payment that is made. Okay, because we still have quite a bit of adjustments. So instead of recording my sundry creditors in the realization account, what I am doing is I'm going to transfer the sundry creditors to its own ledger account. Okay, sundry creditors will have a sundry creditors account by itself. It will not be recorded in my realization account. So therefore, if I'm not recording the original value of sundry creditors into realization account, that means I also cannot sell off I cannot pay off the sundry creditors in this realization account. Okay, so basically we should now close your realization account. This is only in case all of your partners are insolvent. Okay, so total should be rupees 6,650, and you have a loss amounting to rupees 3,600. See, even if you had recorded your sundry creditors, your loss would have been huge anyway. We're already in a deficit, so let's not record it in the realization account. So let's record this by partners capital account. So by partners capital account, A rupees 1,200, B also rupees 1,200, C also rupees 1,200. Why? Because PSR has not been given, right? Profit sharing ratio has not been given. Therefore, we're sharing it equally. We're distributing it equally. So this is the realization account. So let's move on and open the partners capital accounts. Remember again, date has been given. So date, particulars, and the columns for your partners A, B, and C. So in case of partners capital accounts, generally what we record are your opening balances. So as on 31st of December 2014, opening balance or balance brought down for partner A is rupees 800. Partner B does not have a positive balance, and partner C is 500. And partner B has a overdrawn balance. He has an overdrawn balance, therefore to balance brought down. So balance brought down in case of partner B, overdrawn is rupees 650. So now we can record also the realization account, the loss that we suffered. So to realization account, the loss of rupees 3,600. So divided in 1:1:1 ratio. So rupees 1,200 for each partner. Correct? Okay, so we recorded the realization loss. Now, if you look at the balance sheet, we had A's loan, right? There was a loan for A, and since it's been given by name itself, so we have to record it in the partner's capital account. So by A's loan account, under A's column, rupees 1,000. So we have taken into consideration everything from the liabilities side regarding the capital account of your partners. Similarly, in case of asset side also, we've taken everything relating to the partner's capital account. So let us go back to the addition information. They're given there A and C are not able to contribute anything, and a sum of rupees 200 was received from B. So amount of rupees 200 is received from partner B. This is by cash account. By cash account. The amount that partner B has brought in. Okay, so that is rupees 200. And then there are no further information pertaining to partners' capital accounts. So now we can just calculate and see if there is any profit or loss that the partners are getting after we close the account. So let us just close this ledger. Okay, close down this ledger and see what are the totals. So for partner A, total is rupees 1,800. Okay, rupees 1,800. And whatever is the balance, right? The balance that you're getting, let us first transfer it to deficiency account. To deficiency account. Now the reason being we cannot pay the final amount, we cannot pay the surplus to our partners as of yet. Why? Because sundry creditors have not been paid off yet, correct? Now since sundry creditors have not yet been paid off, whatever balance we're having in case of a surplus, we cannot transfer it as of yet to your partners. And then next for partner B total is 1,850. And balance amount is rupees 1,650, again by deficiency account. Okay, by deficiency account, rupees 1,650. And then in case of your partner C, total is rupees 1,200. So deficiency account, we're transferring rupees 700. Okay, when all the partners and solvent, always remember balance of creditors should not be transferred to realization account. And as a result, all available cash that is there should be first used only for payment of your realization expenses, and whatever balance is left will go to your creditors. Now, we have to therefore calculate this way. First, we have to take realization account and then your partner's capital account. So those two are done. Next, let's move on to your sundry creditors account, because if there is any credit balance, if there's any balance that is available in cash, only that can be used to pay the creditors. Okay, so let's open the creditors account. In case of creditors account, we have a balance from your balance sheet, and remember the date column as well. So under this column account, by balance brought down from the balance sheet, rupees 5,000. Okay, so far in case of sundry creditors, we have this amount. Okay, now we don't know yet how much is available. Okay, we don't know yet how much is available. So I want you to move to the next account, which is deficiency account. Let's just record all of these accounts first. And in case of deficiency account, we had entries here, right? To deficiency account, partner A 600, and by deficiency account. So from your partner's capital accounts, we have the entries there. So let's record these entries to partner's capital account. To partner's capital account only for partner B and C. So partner B is rupees 1,650 and partner C is rupees 700. Okay, so total is rupees 2,350. And on your credit side also we have an entry by partner's capital account. Okay, by partner's capital account, this is only partner A, rupees 600. Okay, so that is deficiency account. And now let's go to our cash account. So in case of cash account, firstly, you have a balance. You have a balance there, cash in hand, rupees 50. And remember date column. So in case of cash account 2, balance brought down, amount is rupees 50. And then in case of our realization account, we had the amount, right, on sale of assets, rupees 3,050. So let's record that on the sale of assets. And the entry will be to realization account. To realization account. This is assets realized. So assets realized amounted to rupees 3,050 only. Okay. And after that, we also paid some expenses, right? We had realization expenses. So by realization expenses, they amounted to just rupees 50. Okay, by realization account, in the bracket, expenses. Okay, fine so far. And then in case of your partner's capital account, I hope you remember one of your partners, partner B, he brought in certain amounts of cash, right? By cash account, partner B, rupees 200. So let's record that. Okay, so amount brought in by partner B, therefore to partner's capital account. To partner's capital account, partner B, he brought in rupees 200. Fine. So now what we have to do is we have to close this account. Okay, I'm going to close my cash account and get the total. Total of cash account is rupees 3,300. So now we know the account, the total. Now see the balance. You have a balance of rupees 3,250. Now remember, we still have sundry creditors that have not been paid off, right? So this amount that is available, 3,250, will be used for payment of your sundry creditors. So therefore, we'll write it as by creditors account. And in the bracket, we can just write it as final payment. Okay, this is the amount that is available to pay our sundry creditors. Now let us go to our sundry creditors account. Okay, under sundry creditors account, we have all received money. So therefore, to cash account. Again, if you want, we can just write it final payment amounting to rupees 3,250. This is the only cash that we had left. So out of 5,000, we can only pay our creditors 3,250. The balance now, okay, let's close this account. Okay, close your account, rupees 5,000. And the balance is rupees 1,750. Now this particular balance, the amount that you're seeing here, rupees 1,750, is an amount which will remain unpaid because none of the partners have money. They're all declared insolvent. So this particular amount will be a deficiency which is transferred to deficiency account. Deficiency account. Fine. And with this, remember, this is our balancing figure. So with this, we have also closed our sundry creditors account and we'll move to our deficiency account. Okay, so in your deficiency account, we also have sundry creditors. So by sundry creditors, rupees 1,750. Okay, so let's close this and see whether or not we are getting a total of rupees 2,350. Okay, now if both sides are tallying in your deficiency account, then in that situation, you'll know that your calculations have been correct. Okay, so remember once again, in case when all of the partners are insolvent, like it has been given in the question, then the balance of your creditors, the amount of creditors, it should not at all be transferred to the realization account because they don't have money to pay off that. So all the available cash that is there, it'll be used first towards the payment of your realization expenses. Okay, so just look at your realization account. See, we have recorded your assets and we've sold off your assets, and you'll notice that we did not record the sundry creditors or your liabilities. So whatever money that we're getting from here, we've paid off only our realization expenses, and the balance we're transferring to the partner's capital account. Okay, so if there is any credit balance in your creditors account, look at your creditors account once again. It has, okay, so it's saying if there is any credit balance in the creditors account, it should be transferred to deficiency account. Like under this situation also, we have a final balance here, rupees 1,750, and it is a credit balance and it's transferred to our deficiency account. Now, if we had enough money, right, if we had enough money to pay our sundry creditors, it would not be termed as a deficiency. Okay, if there is excess money, it would be termed as surplus, and as a result, we would not need the deficiency account. But if there is a credit balance, then we would need a deficiency account. So the capital account also is closed by transferring to the deficiency account. So in case of capital account also, see, we're closing it by transferring the balances to deficiency account. Instead of paying out of cash, we're transferring to deficiency account. And based on the deficiency account, we can see how much money we need and how much is available, and then how much we should pay our sundry creditors as well. Okay, fine. So this is how you're solving in case all of your partners are insolvent. Remember, we have additional accounts which are your deficiency account and sundry creditors. Or in case of other situations, you may have other liabilities, right? So those liabilities will show up instead of sundry creditors.